Hi, I'm Brandon Leon, SunCal Real Estate Group. I'm here with Keith Collins of Alpine Mortgage Planning. I actually wanted Keith to kind of share with you a common question that I get, and it's how are interest rates actually even calculated? Not necessarily from a lender's perspective, but overall, like they don't just fall out of the sky. So can you kind of share that with us, Keith?
Yeah, so it's all financial. It comes from stock market and bond market, right? So when we think, I think sometimes the consumer thinks of an interest rate to them, right? The rate that I'm paying on my mortgage. But I think to really get a grasp of where interest rates come from, we got to step away from that and put ourselves in the mind of the investor, right? The person offering the money. To them, it's a return on investment,
Sure.
right? And based on the risk of that investment, interest rates will be different. Right. So if it's a riskier loan, it's going to be a little bit higher interest rate. If it's a less riskier loan, it's going to be a little bit lower interest rate. For example, someone's buying a home as a primary residence and putting 20% down with an 800 credit score. That's not as risky as somebody with a 660 credit score putting 5% down buying a second home.
Sure.
And so interest rates offered to the client are going to be determined based on that risk factor to the investor. In terms of direction of interest rates, they change all the time. They change multiple times a day. I have an update service that sends me a text message sometimes 10, 15 times a day that interest rates have changed.
Yeah.
So not to say that I sell a product, but we do in lending, lenders sell a product that the price changes every day, and sometimes it changes multiple times a day.
Right.
Where I think we need to understand is kind of where we at in terms of the direction for interest rates. Now, what I always tell a client, a good indicator of rates and where they're going is what's the stock market doing? Because everybody real quickly can find out what the Dow's doing, or what the S&P or the S&P 500 is doing. Anytime the stock market's having a good day, interest rates are having a bad day. And anytime the stock market's having a bad day, interest rates are actually having a good day. So, as a global economy, we're kind of the cleanest dirty shirt in the laundry. That's what I like to tell people, right? The U.S. economy is doing really well. It's not doing great, but compared to everybody else, we're pretty darn good. And that's why our interest rates are low. People invest in bonds, and that investment in the United States is actually what's keeping interest rates low. So as we continue to grow and do better, and the overall economy gets better, interest rates will be higher.
Wow, no, that's great information. I think that a lot of times people just say, well, I'm just going to buy a home and this is my interest rate. But I think that a lot of people have that question of where does it actually come from? So I appreciate the time. Thank you so much, Keith.
Thank you.
All right, take care.